Thank you for joining us. We are here to talk about the blockchain and the marvelous and fascinating and somewhat scary implications of it. My name is Satoshi Nakamoto. I'm Marc Hochstein. I'm the editor-in-chief of American Banker, and the blockchain is something that our readers have been very interested in learning about for about a year or so, and I've taken a personal interest in this technology for a couple of years, from back when Bitcoin was this weird thing that people were kind of treating like a joke, but I always thought there was something there. I'm going to ask each of the panelists to briefly introduce themselves and explain their involvement in the space, and then we'll dive right into the conversation. So starting at my far right, Brian.
Sure. I'm Brian Forde. I'm the director of the Digital Currency Initiative at the MIT Media Lab. We run one of the largest academic research initiatives in the world on cryptocurrencies with about 10 to 15 staff and professors and about 40 graduate students studying the technology.
Hi, I'm Jalak, Jobanputra. I run an early stage venture fund in New York called Future Perfect Ventures. Started looking at the Bitcoin and blockchain space 3 years ago. And it reminded me a lot of the early days of internet investing. And I made my first investments in the space 2 years ago and have 10 portfolio companies in the sector.
My name's Leanne Kemp. I'm the founder and CEO of Everledger. We're a startup based in London that is digitizing diamonds onto the blockchain as a way to reduce fraud in insurance and open networks.
My name is Margaret Liu. I'm with the Conference of State Bank Supervisors. We're the Washington-based policy organization for state banking and financial service regulators, and our members have been involved in looking at, from a regulatory perspective, virtual currency activities for the past several years. And we have an ongoing interest in the development of blockchain technology and a lot of the fintech innovations.
I'm Steve Wager. I'm the product head for the ItBit Trust Company. ItBit Trust is actually a mix of a fintech company as well as a financial services company. We have a proprietary value prop around securities and commodities where we're looking to deliver T0 settlements, shortened settlement timeframes, new collateral frameworks, and new products off the back of that.
Just to before we dive in, how many people here in the room first heard the word blockchain within the last 12 months? Pretty good number of people. How many people here have ever used a Bitcoin wallet? Don't be shy. We won't tell your compliance department. So maybe just to kind of set the foundation for the conversation, Brian, can you just talk about how this technology came into being, what Bitcoin is for the uninitiated, what the blockchain is for the uninitiated, and how the conversation has really evolved in the last year or two?
Sure, absolutely. So it looks like in the audience, it's over the last year, you've started to hear a lot more about Bitcoin and the blockchain and what is it, and I always say that there's like 4 levels of understanding. There's a first level that is this is crazy, why bother, right? And then the second level of understanding is this is still crazy, but interesting, smart people are starting to talk about it. Level 3 is, okay, I get it. I can start to see the world through the Bitcoin blockchain eyes. And then level 4 is nirvana. We're not going to get to nirvana today, but I hope many of you are probably at level 2, and maybe we can quickly get you up to level 3. So some people say that Bitcoin and the blockchain are crazy. I would argue that the world that we live in today is crazier, and I think we just take for granted certain frictions that we have. I'll give you a simple example, right? So if I was to say to Jalak, I'd say, hey, Jalak, I want to send you an email, it'd be really simple. She'd say, okay, my email is, jalak@gmail.com, right? I say, great, right? And I send her an email. I don't ask her, are you going to use an iPhone to check that? Are you going to use Gmail to check that, Hotmail, et cetera, right? I don't ask any of those questions. It's just open and interoperable. We just send information back and forth, and we think that's wonderful, right? However, if I were to say, Jalak, I'm going to send you 10 bucks, right? We would play a game of 20 questions, right? I would say, are you on PayPal? She may say, I forgot my password. She would say, Brian, are you on Venmo? I would say, I'm over the age of 30. right? Like,
And then I'm going to make you spend $15 on fees to send a wire.
right, exactly. And we just go back and forth. And then finally, we'd probably get to this situation where I'd say, like, okay, what's your bank and what's your bank account number and what's your branch address? I don't know. There's a lot of branches around me, right? We just kind of go back and forth to send this $10. I'll say it'll get, and by the way, it'll get there in like 3 or 4 days, and you won't get $10. You get $7.50 or whatever it is, right? So it's actually relatively hard to send money. We kind of take that for granted here in the US, for example, because it's generally pretty easy access to get to an ATM or use your credit card anywhere. But if you think about it, these simple things are actually much harder. And with Bitcoin, for example, or any cryptocurrency, you just say, okay, what's your Bitcoin address? Kind of similar to an email address. And we can send money back and forth seamlessly. The friction, doesn't matter what application she uses. I don't have to ask her if she uses PayPal or Circle or Zappo or any type of Bitcoin wallet. It doesn't matter. It's open and interoperable, kind of like your email. And that reduces a lot of friction for being able to send money back and forth. And I think that's incredibly powerful. But then if you think about it a little more, how many of you have bought a ticket on StubHub? Yeah, it looks like the majority of you bought a ticket on StubHub. I assume you trusted StubHub for that transaction, right? You're going to get your ticket. Well, we just had Kobe Bryant speak here earlier today, and interestingly, about 2 weeks before he announced his retirement, there were 4 guys who bought tickets on StubHub for what they thought was going to be Kobe's last game, right? Great. So they bought their tickets, about $250 a pop each. Wonderful. And then 2 weeks later, he announced his retirement. Ticket prices shot up to about $800 or $1,000 a ticket, right? StubHub kindly reaches out to them and said, thanks so much for purchasing those tickets. However, you don't actually own them. We're going to take them back. And we'll give you a $250 credit, though. They're like, we don't want your credit. We want to go to the game, right? And so what's interesting about that is corporations own ledgers, right? Like StubHub owns a ledger, and they can take back those tickets, for example, so you don't truly own them, right? Or banks got their hands slapped, for example, by the Consumer Financial Protection Bureau, because what they were doing is they were reordering checks based on the amount of the check, right? So if I wrote 3 checks, maybe my rent check, my utility check, and maybe my cable check, right? They would reorder them highest to lowest to increase the likelihood that I would have an overdraft fee, right? And so then you start to think, oh, wow, it becomes really powerful to have a decentralized ledger, a ledger that maybe a corporation doesn't own, right? And I think what was most interesting about the internet is that what we saw is today we communicate with our friends and families electronically, cheaply, efficiently, and the amount of communication that we have now versus maybe 20 years ago has increased exponentially. And what Bitcoin and the blockchain start to do is reduce the amount of friction so that you can increase the amount of transactions exponentially as well. And that's what we think will ultimately happen, enabling peer-to-peer transactions, because you don't have a company in the middle who is in charge of that ledger, which becomes really interesting. And I think that's part of what becomes really powerful. And it's not just for money. It's for any form of digital asset. So for example, you could append a concert ticket, right, or an event ticket to a nanocent, can be in my wallet, and then I can transfer it to you. And now you know that you're the actual owner of that ticket, and you don't have to say, oh, well, did that person send that ticket to 10 other people, right? Because it's just a PDF. So it's the same thing for music and books and movies, for example. We don't really own those anymore. When you click buy, right, on Amazon or on Apple, that's actually a lie. It's actually a lifetime lease. You can't resell that. It's illegal to resell your music. But before, when we had DVDs and CDs, it was great that we could resell those, right? That's why we had all these DVD rental shops, etc. Or you could give it to a friend. Now, you can't do that today with your Kindle books or your Amazon or your Apple songs, etc. And so all of a sudden, you start to see that these ledgers become incredibly important, not just for the transfer of money, but as we've moved to a digital world for a lot of our entertainment and other assets, we can start transferring other types of assets using cryptocurrencies like Bitcoin, which becomes really interesting. And I hope that was kind of helpful for getting us started and starting to understand why this could be so powerful.
And two things I'll note in what you just said. So the power of this thing is that it's immutable. That starting with the Bitcoin transaction, when a Bitcoin transaction is done, it's done. It can't be reversed unless the person controlling the transferred funds decides to reverse it. And that's just a theme you'll hear a lot about when we talk about blockchain applications for other uses, is immutability. The other interesting thing is that it's taken these digital goods and it's made them rivalrous, which is you know, sort of an interesting, given that, you know, all the issues around, you know, people sharing MP3s and things like that. Is that now you can say, I used to own this, now you own it, and I don't own it anymore. And then there's a
yeah, and I think it's also important to think about people kind of conflate their ideas about, you know, what Bitcoin is versus what, like, a credit card, how a credit card's used versus what a cash is, like how cash is used, right? And it's important to think about, you know, how they're similar and how they're different, right? So the similarity between a credit card and Bitcoin, for example, is that both of those things you can use online to make a purchase. But if you think about an informal cash-based economy, you may have 50% internet penetration, but you can't buy anything online because you don't have access to banking services, right? So all of a sudden, Microsoft is starting to accept Bitcoin for things like Xbox. So maybe if you're under the age of 18, you can start to buy things online. Or if you don't have access to a credit card, you're not banked, you can still buy things online. However, it's also similar to cash, right? If I left 20 bucks on the ground, right, and I'd walk away, and then I go back to look for it, and it's gone, I don't call the U.S. government and say, hey, can I get that 20 bucks back, right? However, with a credit card, you can reverse a transaction, but with Bitcoin, you can't. So it has some properties of credit cards and some properties of cash, and it's important to think about what you're trying to solve and seeing if Bitcoin, credit cards, or cash makes the most amount of sense.
I want to turn to Margaret, because there's a couple things that Brian said that I think over the years have raised some eyebrows in the regulatory community. It's an open network, which from the point of view of an internet person is awesome. But and it's neutral. It doesn't really care who the parties are, and these are virtues in the internet world, but they're unspeakable sins in financial regulation. So, Margaret, can you talk about the initial reaction when Bitcoin first came on the scene in the regulatory community, but also how that's evolved, particularly as we started talking more about blockchain versus Bitcoin?
So, you know, I think that the reaction in the regulatory community is not really any different than the reaction that you saw in this room in terms of the raising of hands and, you know, the general population's development of understanding and knowledge and awareness. Because when you think about, you know, what are regulators and what are regulatory agencies, you know, what is regulation? It's groups of people who have the responsibility for implementing and sort of enforcing a set of rules. And so the people part, you know, regulators, like others, have to spend time to learn about the blockchain and about Bitcoin. It is, you know, it's tough to keep up with, frankly, I think, for a lot of people, because the use cases keep changing. I mean, just to even, you know, on this panel, you have, you know, a wide range of use cases exemplified. And I'm sure some of the stuff that Brian and his team at MIT are doing is just going to, you know, further explode that. And so you have to think about, you know, what is it and what are the risks that it presents? So that's what regulators worry about, right? Managing the risks. And some of the examples that Brian mentioned, you know, illustrate both the opportunities but also the risks, because his example, kind of cash versus, you know, credit cards, is a real good case about consumer risks and understanding. And because of the existing financial services space, consumers have developed certain expectations. I kind of know what's going to happen if I use a credit card to pay for something, if I, you know, write a check or do a transfer, you know, online transfer out of my banking account to somebody or to, you know, to pay a bill. I have some set of understood expectations as to what my rights and responsibilities are. And in the virtual currency space, those aren't necessarily there unless they're individually or bilaterally agreed to. And I think that, you know, it's not so much, it doesn't have to be about more or different regulation, because part of it should also be about just information and customer awareness. And if you look at what regulators have done, CFPB, the state regulators, the folks who I work for, one of the first things we did was to put out some consumer guidance. It could get lost. It could be taken by fraud. There's no FDIC insurance. Just some basics, again, just to begin to grow the customer, the consumer's knowledge. You also, I think, were alluding to some of the issues around know your customer, and some of the law enforcement priorities around the movement of money. You have a whole set of rules and laws that seek to do some of the things we talked about for those who are at the big luncheon discussion around combating the financing of terrorism and combating generally the financing of bad acts and activities. And regulators have a role to play there too. And the anonymity, or I guess the term is pseudonymity, of a virtual currency really challenges that. And so there's a balance that has to be struck, but there's also a compelling legal obligation around knowing your customer and knowing the folks and the entities at both ends of a transaction, reporting movements of large amounts of cash that banks and other financial institutions and intermediaries have. So the risk is the same. The regulatory approach might have to morph to meet what we're regulating. But it's not a new risk. It's an existing risk, and it's just about understanding it in the right way to modulate the regulatory response.
And over more recently, people are talking about the blockchain, not Bitcoin itself, but the blockchain itself as a potential tool for the regulator. Mm-hmm. How does that work?
So the term, I guess, is RegTech, which I think is as amorphous or perhaps even more amorphous than the term fintech. And in some senses, RegTech is it's not necessarily a new concept. I mean, there are a lot of companies out there that have developed a lot of different tools for regulators, for regulated entities. Regulators themselves develop innovative technological tools to help them do their jobs. I think that there is a lot of talk about the blockchain offering a lot of prospects in the RegTech space, but we get back to the learning curve that I talked about, that everybody has to everybody has to climb, and it's about understanding and a certain amount of acceptance, and regulators having the opportunity at the right time to kind of kick the tires. But I guess I would throw a question out to the blockchain community in terms of coming to regulators and talking more specifically about what is this RegTech opportunity, and kind of bringing some specifics to the dialogue. And I'd encourage blockchain advocates and those in the industry to bring those to regulators.
Steve, what is the RegTech opportunity?
We see this fantastic, and I don't mean to foreshadow here, but I think this parlays nicely into our idea of a permissioned versus a permissionless blockchain.
Yeah, explain those terms.
So from our perspective, we have obviously a permissionless blockchain, which is the public blockchain that supports Bitcoin today. That means anyone in the world can download the software, anyone can operate a node, anyone can actually be a validator of the transactions that we were just talking about.
Much like the internet itself.
Exactly, that's right. A permissioned blockchain is something different. On the permission side, you actually have on and off ramps in the form of KYC, compliance. You need to be able to know who in fact is operating the node. There's legal agreements, typically participation agreements that support that. So in the case of fraudulent activity, there is recourse in the form of our normal legal protections that exist today. And in fact, it offers a whole host of other opportunities, particularly around regulation. And what this means is if you have a permissioned blockchain, if all the participants agree that if we wanted to give Margaret, for example, the key to be able to see all of the data in the transactions, they can absolutely see everything. And what this does is it changes the game in regards to trade reporting, trade interfaces, audits. So some of the big consulting firms are also somewhat concerned about this. And the reason for that is that people can actually reach in, query the chain, and be able to get all the data that they need to be able to support investigations, normal types of transactions reporting, and all of this can be standardized as a push mechanism through to the regulator.
Now, if I'm a financial institution, like if it's a bank CEO, if it's someone like Jamie Dimon, and they look at this, what's in it for that person? Aside from compliance, which is very important, what's the business rationale for using a blockchain? What problems in financial institutions are they trying to solve with this?
Sure. If I just won't take too much time on this, but I'm somewhat conflicted as a participant because I actually spent 20 years of my career at JP Morgan, as well as at Citibank, where I most recently left, and then have now recently joined the fintech space. And I guess what the reason why I say that is because of the fact that banks actually are in a unique situation now whereby they're constrained from a capital perspective in regards to meeting all the compliance requirements of Dodd-Frank, of Basel III, et cetera, et cetera. I know this isn't news to most people in the audience. And what that means is that it costs more on every single dollar that they actually earn in revenue to actually support the business. So if you think about gold as an example, let's go through a quick example. Gold has two main types of flavors. You have allocated gold and unallocated gold. And people may not know, but unallocated is really an investment in a pool backed by a clearing bank, right? So you're not actually buying real gold, you're simply buying a credit instrument backed by the price of gold. Now what this has is it actually is treated as cash on the balance sheet of the bullion bank, right? So that treatment of cash attracts RWA, it attracts LCR, it attracts NSFR. So based upon our calculations, for every 100 billion in assets that this bullion bank might be holding, it actually requires them $120 million worth of capital to be able to support that business. Translated at a cost of credit is very sizable. So now if you think about gold, for example, you may have read in the newspaper recently that Barclays exited the business, Deutsche Bank has exited the business, and that's really all around these margin and price compression points. Now, if we think about a blockchain and you translate that to the equity space, equities here in the United States are supported by the NSCC and the DTCC, the NSCC being the clearing division and the DTC being the depository. In the United States, the NSCC earns $250 million off of that clearing activity. They actually hold $6.3 billion in capital against the clearing activity. And then underneath that, you also have the DTC, which requires full collateralization of the activity in the United States. And in addition to that, has a $13 billion credit facility, which all the participants actually have to participate in. Now, if you can imagine that I'm the Jamie Dimon and my trading business has basically been nullified by Dodd-Frank, I have all these Basel III requirements coming after me from a compliance perspective, my margins are only shrinking, right? So what am I going to do? I've got to be able to cut costs and cut costs significantly. And for the banks in today's world, we're not talking about a 5 or 10 or 15% cut. You're talking about 30, 40, 50% cuts, right? And this is why you're seeing across the industry now banks laying off thousands of people, closing businesses, shuttering different types of trading businesses because they simply can't support it. It's unprofitable now. And one of the ways that they could actually get over this hump to be able to make those businesses profitable is the blockchain, right? So now in this idea that every transaction is now a bilateral transaction, theoretically, we don't actually need all these central counterparties to stand in the middle. We don't need the NSCC to be able to stand there and collect collateral. We don't need them to margin the activity because each participant takes the responsibility against each other. So what this means is that if you couple that with a T0 environment, which means that all of the transactions are settling on the same day, as opposed to the way it happens today, and today it's usually a mix of T3 or even further out, you can actually have a scenario whereby risk is collapsed, and we actually have a safer environment than we do today, but is dramatically cheaper.
And I'm going to want to get back in a little bit to the implications of a T0 world. But before we do, Leanne, your company has a really interesting application of the blockchain with the diamond industry. Can you talk about what the problem is that you're addressing there and why the blockchain is the appropriate tool?
Sure. So I guess we started about a year ago and digitized around 1 million diamonds in industry. A number of financial pressure points are facing the industry, as well as a proliferation of fraud. And the work that we have focused on in the first instance is really around how do we get a digital incarnation of the diamond onto the blockchain. And we did that by creating 40 metadata points of the diamond, as well as the inclusions or the faults within the stone. And we wrote that into the blockchain as a baseline to be able to then see where diamonds are being sold and resold online in open marketplaces, but also with inside of the pipeline. In the 1950s, GE created synthetic stones, and they were created for industrial purposes, blade saws and diamond blade. But in more recent times, we've seen the onset of synthetics becoming gem quality standards, and those diamonds are peppering not only the middle part of the pipeline, but they're now proliferating into open marketplaces and causing.
Does that count as fraud if it's a synthetic diamond, but if it meets all the characteristics of a diamond from the ground? Is that considered fraud?
That's a good question. So in February, Alibaba banned from trade a number of traders that were selling 10,000 carats of synthetic stones with genuine GIA certificates. So they're very real problems.
Mm-hmm.
Yeah, so that's the problem we're solving, right?
Yeah.
Well, that's one of many. But and in terms of what we've built out now, it's very clear that we become the scaffolding or the rails of a risk platform for both insurers and financial companies that are supporting the supply chain element of the diamond industry, where we've seen double financing of the pipeline, where we've seen a securitization that's been taken on top of inventory packets, but ultimately when they go to inspect, they're not real diamonds, they're synthetics. That's only one element, but very clearly it's a value proposition that stems from not just identifying the source of the diamonds as to whether they're from ethical sourcing, whether they've passed legitimately through the Kimberley process and from non-conflict zones, or whether they've actually been peppered out through the supply chain and ultimately have come into the consumer network as a synthetic.
And how exactly does the digital ledger know what's going on with these physical objects? Is there attach a chip to the stone?
Yeah, no, we don't attach a chip. So the pipeline itself has been relatively dumb in so much that it hasn't been IoT enabled. There's been a use of different layers of technology. Spectrography would be one of the main sources. But those machines have been black boxed across the pipeline for a number of years. The industry has, announced a number of monopolistic leaders in the space, not just within sort of the trading belt, but also within the technical advancement points. But we're starting to see the onset of sensor technology and nanotech, and this becomes affordable. So with use of high definition photography and our digitization of the diamond, we can take not just the DNA of the diamond or the thumbprint, we can now take a facial recognition of the stone at an affordable level and then match that back. So is the certificate, does it match the real stone? Does it match the photograph? Is it truly that exact diamond? So we're starting to see that become affordable. Probably that's only really started to come into an affordable belt within the last 2 years. Up until that point in time, industry has been reliant upon machines of $10,000 and $25,000 US. And now this technology is available and affordable in the hands of consumers or even in retailers at sub $1,000. So no, we don't put a marking on the stone and we don't RFID tag the stone, but we're actually hard handshaking to machines that identify each of those diamonds.
It's really interesting. And one more point, which I think is worth making, since people tend to have these very binary conversations in the space about public or private, Bitcoin or permission ledgers. You're using both, is that right?
Yeah.
How does that work?
Yeah, so we've used both. I mean, ultimately, the attributes of each of the ledgers has a certain secret sauce that you can apply to being able to solve certain problems in industry. And for us, the private ledger and the ability to be able to have a consortium of trusts, particularly around government institutions as we start to digitize the Kimberley certificates, which is cross-border trade, we wouldn't necessarily put that on the open public network. We would, of course, because we're very mindful that diamonds is still a large vehicle for anti-money laundering and terrorist-funded activities. There's no denying that. So we use both the public and the private and our private stack. I don't see that changing in the near future.
One of my favorite, another sort of really interesting thing that people talk about in conversations about blockchain technology is identity, and that's a big problem for the banking industry. And when I say identity, that's like envelops a lot of different disciplines. There's AML, KYC, there's fraud prevention, there's customer privacy, there's authentication, and there are a number of startups that are trying to solve all those issues in kind of a holistic way with the blockchain. Jalak, can you explain what the reasoning is there?
Yeah, so just taking a step back from some of these specific use cases, one of the reasons I'm so excited about blockchain technology is its implications for identity and what that means for expanding the global economy. And I think about it in three buckets. One is individuals. So right now we have 3 billion unbanked people around the world. We have a number of hundreds of millions of refugees. The number is growing. A lot of people who are not included in more formal economies around the world and have been displaced. And I mean, we've been hearing all at this conference about the political and implications and the instability that arises from from this this lack of people being in this global economy, and the blockchain can help bring a lot of those folks into this economy through identity, giving them identity. They can get passports, ID cards, get access to government services, and it just comes from being authenticated once. It could be biometrically, and then they get a key for the blockchain, which has access to all their information, and then they can now be mobile and get access to different services. And we're seeing some of that happen in places like Africa, where the unbanked are able to access financial services because their information, their kind of credit worthiness, their reputation can be transferred onto the blockchain and verified.
That's already in production? That's already...
It's in process of happening, yes. And then the second is what you mentioned with the KYC. So it's how do we create more efficiencies for the financial industry. And right now, over $10 billion is spent on KYC compliance. It's a process that can take up to 50, 60 days. And if you think about being able to just go through that process once and then be able to broadcast that out and share all the verification and the data associated with the verifications on the blockchain, and this can happen in an instantaneous way. I would say, the regulators would actually like that process, and it's all possible. And so I actually think the positives for the industry and compliance and cost savings, and then also bringing more people into the financial system is a net positive out of all of this. And then the third, which Leanne touched on a bit, is really the Internet of Things. And my fund focuses on blockchain as well as artificial intelligence, IoT, and all the data that's going to be created from all this distributed connectivity of people, enterprises, and machines. And we're going to have over 25 billion sensors online very soon. That number is going to continue to grow. And there are going to be microtransactions of data that are occurring between devices and people. And we can't live in a world where all this information is just being siloed off and not being able to be utilized. One example is solar panels. So you can theoretically get solar panel information on the blockchain, so you can see how much energy is being generated, and then it's in real time, can inform energy traders about the usage. So I would just encourage people to think kind of creatively about what it means when we can have real-time and kind of global transfer, low-cost transfer of information, and how many industries that can impact. So really, everything can have an identity in this world with data associated with that identity.
Now, you raised, I think, some privacy concerns in the back of my mind here. When we talk about putting an identity on the blockchain, surely we don't mean putting everyone's personal information in a public forum that anyone else could look at.
Right. And that's the key, right? What a few of my portfolio companies are working on is that authentication piece. So, I think it's very important that once information is put on the blockchain, we have to be able, whether it's an individual or a business, we have to make sure it's not abused and you know, being broadcast in ways it shouldn't be. And that's where the permissioned and public blockchain come into play, where I strongly believe in a lot of these use cases, you're going to have a hybrid, and you know, that even a lot of companies in the open source world have contributed some of their code to some of these permissioned blockchains for that very reason. And so one of the companies I'm working with requires fingerprint and biometric authentication to if you want to transfer your data. So someone else can't hijack your key and then transfer that data.
But the fingerprints themselves are not in this public database.
Well, they could be or could not be, or pieces of your fingerprint could be. You know, it could be distributed. Some of that data can also be distributed. So there are lots of possibilities here. But the key is, I mean, right now, I mean, if you look at health records, they're the most expensive thing that gets sold on the dark web because of prescription abuse. Insurance companies' databases are not secure. So think about a world where we can, and actually Estonia is experimenting with this, where you can put health records and then permission them out with biometric authentication.
So the individual has more control over who sees what and under what conditions.
Yeah, I mean, that's the world I would like to see. And again, with businesses having that same ability to permission information out. And I think that's been some of the challenges with the public blockchain and why, you know, we're moving to more of a hybrid model to be able to address the specifics that each industry or sector needs in terms of security and privacy. So
I'm going to throw Brian a curveball here. Because you mentioned solar panels, Jalak, and there's a lot of talk about environmental issues here at this conference. Why do people say that Bitcoin mining is an environmental liability, Brian? And do you buy that argument? And and also just explain mining for those who don't know it. But is it an environmental issue the way some people say, and is that unavoidable with this kind of technology?
Sure. So mining is kind of like payment processing in a way. And so what you have are a series of servers that are around the world that different individuals or companies own that are competing to process all of the transactions on the Bitcoin blockchain, for example, in a span of 10 minutes. And the reason why the Bitcoin blockchain has never been hacked or the ledger's never been fudged is because it has the most amount of compute power that is protecting it. What that means is if you want to fudge the ledger, you need to have 51% of the compute power around the world to be able to fudge the ledger. Now, how much compute power is protecting the Bitcoin blockchain? Some people have said that there's more compute power protecting it than all of Google's servers combined, so a significant amount. So if you were to fudge it, you'd probably have to be a state actor, but then you would probably realize that has happened, and then you'd have to kind of figure that out. So that's mining, and people. The reason why it costs so much energy is because what it's doing is this thing called proof of work. And all of these servers are using a tremendous amount of energy or have a cost to try and compete. And what they're trying to win are a reward, which is today about 25 Bitcoins, which is about $10,000 or so every 10 minutes. And so it does consume a lot of energy. But then, you know, I might ask how much energy is used how much energy does MasterCard use? Right, their entire company, right, to process all of those transactions, right? It arguably is probably higher than the amount that Bitcoin is using. So I think it's
that's because they're probably doing a lot more transactions. If Bitcoin scales, wouldn't this be an order of magnitude greater in terms of the environmental impact?
Yeah, and one of the things that we just talked about, or that we just wrote a post about, is solar coin. Where you can use solar power to start to do mining. So, you know, part of this is also figuring out how you can use renewable energy better. So this becomes just more of like a renewable energy question. Cooling as well, how can you more efficiently cool your servers? So this kind of gets into the same space of, how much energy does, all of the servers combined in the world to help us access websites, right? It's a significant amount, right? And, the companies are financially incentivized to reduce those costs. And similarly, mining companies compete on the operating expenses that they have to try and to do the payment processing. So they're also incentivized to either use renewable energy or cheap energy to be able to do this and reduce their costs on cooling as well. So it's certainly an issue to be thoughtful about for the environment, and I think people are looking at different ways that they can achieve that.
And in a couple minutes, I'm going to want to open it up for Q&A. I want to get back to Steve, though. We've had, for about a year now, blockchain has been the big buzzword. It's been in the headlines. We haven't seen a whole lot of actual use of it, aside from Bitcoin and aside from companies like Leanne's. There's not a whole lot in the wild right now. What's in production right now? What's actually being used, and how much of it is just sort of like pilot tests and banks just doing things in a controlled environment, and how much of it is actually out there in the business world?
Sure. And before I answer, I can say I read a small statistic recently, just that if the Bitcoin network, the public Bitcoin network, actually did scale, it would consume the same amount of electricity as the entire country of Ireland. So it is theoretically an issue. In regards to what we were just talking about, for use and what's actually moving through, you actually see a number of small use cases moving into production. Factum is a good example of this as well too. We have governments that are trying to experiment with it. A lot of banks have created what we call altcoins to be able to try out, can they move them between their own legal vehicles internally, and all of that is then moving through. I think the way that we look at it is that 2015, was the year of education, right? People said, hey, what is this? And everyone started to ask the questions, and we all got around the table and spent a lot of time just talking about it. And for me, coming from the banking space, I actually thought that that was one of the most interesting eras, and we'll kind of be sad to see it go, because it's few and far between where you can actually have open dialogue between all of the market participants who come together, and to some degree without competition. Because I think even outside of the database nature of blockchain, you still have the element of this is actually an opportune time for us just to sit back and say, hey, is this a time for us to re-engineer what we thought we needed for the past 40, 50 years, whatever the case may be? And that's actually driving the dialogue. From that point, though, now into 2016, we actually started to see some fractionalization of the providers, right? So you've got DAH, you have us, you have a number of other providers that are actively out starting to sell software now, right? Trying to actually drive participation in use cases. And what we see for 2016 is this is actually going to be the year of the proof of concept. So people will actually formally commit to working on a use case with a particular firm. People will start to do paper trades or paper transactions, start to work out the details of it. And then in 2017, and I'm hopeful that early 2017, in fact, we're actually going to see particular use cases move into production. Our firm, for example, will actually be in production in 2017 for a commodities use case. So I know you're probably reading a lot of projections that, yeah, 2017, 2018, still testing. We're really much of the opinion that you will see things in production next year, and then the 5-year scale will actually, or 5-year looking forward, will actually be a scale and ramp up into people actually starting to make active use of it in their daily life.
I agree with that. I think that what we're still seeing an infrastructure build out in the space where right now it takes 7 minutes to confirm transactions on the blockchain. There are companies that are working on getting that to be instantaneous through different types of technologies and infrastructure. So we're seeing the infrastructure development while we see the applications also start to develop, and that will all start to come together in I'd say a year or two. And a lot of, there's smaller use cases, like the governor of Delaware just announced yesterday at the big blockchain conference in New York that they were going to start enabling issuance of shares, private company shares on the blockchain. So, I think as we start to see some of those, I'd say, non-trading, lower volume assets getting on the blockchain, they'll start to kind of prove out what the technology is capable of.
if I can just make one extra comment there in regards to collaboration and regulators, it's been particularly encouraging to us that the regulators are very open to these discussions. They're saying at the same point, hey, this could be a benefit for us, this could be a game changer, but work with us to get to the right decision, work with us to get to the right solution, and maybe not be cowboys. So we're trying to balance that in between the ethos of blockchain versus a regulated environment.
You mentioned T0, going to a T0 world earlier. Are we losing something if we get rid of netting and we go straight to bilateral settlement? Is there some other type of risk that's being introduced or reintroduced or amplified if we go to bilateral and we go to instant settlement?
So I'm going to take a couple different approaches here. I'll be quick. So in regards to that, if you think about, again, settlement banks or custody banks, clearing banks, et cetera, and again, I know this is all out in the space, but most of those systems are actually 40 plus years old, all written in COBOL, right? So one of the main blockers for us actually moving to bilateral gross settlement is the fact that the bank's back office systems simply can't handle it. And so this is one of the main reasons why we have the NSEC. So the NSEC steps in, and if you're familiar with the order flow coming, let's say, from the New York Stock Exchange, somebody puts in an order to buy 1,000 shares of IBM, that actually gets filled in multiple pieces called executions. All those individual executions come back to the NSEC, and the NSEC compresses those into a net. And that net is one buy or sell per security per day. And then they hand that back to the market participant. Now, if in fact we started to model this with market participants, they said, oh, if you start to actually hand us back all of the executions, our systems are going to fall over. So we're working through that element of it, and I think that we'll actually still have, on the blockchain, we have the ability to create compression modules to allow these to be able to happen as they do today. When you talk about a risk perspective, it is a change of culture, right? So in today's world, you have a central counterparty who stands in, they novate the trade into their own name, they accept all of the risk of that. People may not know this, by the way, but the DTC actually only guarantees the trade on the evening of T+1, even though you pay for it for the full day. So that's something that we use to our advantage in that. But anyway, what that does is if we talk about now shifting that or removing the NSEC and the DTC away from that operating environment, the risk becomes pushed back directly to a bilateral basis to each counterparty. If your counterparty fails, you have to sue them, right? You'll have to actually take the recourses. You have to take the full responsibility of your trading environment. But the mitigant to that is that on the blockchain, you're 100% sure that they actually have the position they say they do. You can actually check it in advance, and if we ever get to the position where we have Fed dollars tokenized on the blockchain, you'll have 100% surety of your transaction before it actually happens.
Can I jump in on that for a minute? I don't want to cut into the audience question time too much, but I think that everything that Steve is talking about applies more generally, or just about everything you were saying applies more generally in the payment space, to be, beyond trading and settlement. And so the emergence of the blockchain over the past several years, at the same time that the Fed and the existing kind of financial services infrastructure has been looking at modernization of payments and of the payment rails. And I know there's a panel later on this afternoon on real-time payments too. I don't know if it's a coincidence or not that the blockchain has kind of emerged at the same time that we're confronting legacy payment systems and looking at the right way to modernize the existing rails that we have to real-time settlement. And some of the same issues that Steve mentioned in terms of the rights and responsibilities and your ability to recourse. It goes back to Brian's point in terms of what recourse do you have and what happens with real-time payments generally too. And so it's a lot for the marketplace to deal with, and certainly for regulators to deal with at the same time.
So questions from the audience. If you have a question, wait for the mic runner to come over and bring you the microphone.
Hi, thank you very much. In discussion, the one part I'm still not certain of is the blockchain makes a lot of sense to me. Why is it necessary to have a separate currency? Why couldn't this be dollar pegged or gold pegged or something else that has, at least a more established intrinsic value?
Great question.
Yes. Take it.
Start with Brian.
Yeah. So the Bitcoin is what, for the Bitcoin blockchain, for example, is what creates the security of this, right? And so you need to financially incentivize the miners to do the mining or the payment processing that protects the network. And if you don't have that, that Bitcoin or that native token, it helps in two ways, right? So first, you need that token to be able to pay the miners. But second, that token is what transfers the asset, or it's what is worth a certain amount of money that goes from one person to another, and it's ultimately divisible to about I think it's 8 decimal points. And so you can continually break down that Bitcoin. One Bitcoin today is worth about $450. And so you can break that down into a fraction of a cent as well. But it has to be its own currency. You can't just like take another currency and just plant it onto it and then pay miners with it. It technically wouldn't make sense. However, central banks are starting to look at creating state-backed digital currencies, and either looking at the Bitcoin blockchain to do that, or doing it with a private blockchain, which becomes really interesting as well. Bank of England's exploring that, as are other central banks as well.
So is Ethereum going to supplant Bitcoin? And then is something else going to supplant Ethereum and ad infinitum?
Yeah, I think Ethereum is an incredibly powerful technology for smart contracts. And I think what you're starting to see is...
Explain what a smart contract is and why Ethereum is uniquely suited for that, where Bitcoin might not be.
Sure. So a smart contract is basically what happens is, let's say like you and me placed a bet, right, on the Lakers game, and it would basically escrow $10 out of my wallet, escrow $10 out of your wallet, and then there'd be an oracle. And that oracle, we would say, would be ESPN, that neither you nor me has influence over ESPN. And so when that ESPN score drops and it says, Brian, you lost the bet, then it would automatically take that money and drop it into your wallet. And you wouldn't have to like hit me up and say, hey, Brian, where's that $10 you owe me, right? So it automatically executes contracts, and it's secured to the blockchain. And so then that becomes incredibly powerful for micro-insurance transactions or other types of transactions that require a lot of paper and a lot of trust. And so that significantly increases the operational efficiency to be able to do like micro-insurance transactions, for example. And the Ethereum is built out to do that better than the Bitcoin blockchain right now. And so you're starting to see these special use case cryptocurrencies start to develop. So
coming back to the question, does Ethereum overtake Bitcoin? Can they coexist? Will something else come along that knocks them both out of the box?
Yeah, no, I certainly think they can coexist for different types of use cases. And there are other cryptocurrencies as well, like Litecoin, for example, that it's worth less, and it has less security in terms of computational power, but it verifies transactions quicker, right? So I think it's just depending on what's my use case, right? How important is security to me? How important is decentralization to me? How important is how quick these transactions are being processed? How important is it to how many transactions per second? So you just look at your business case and see, oh, with all of these variables, I think that this is the most important for me, so I'm going to adopt that platform.
And I think, too, there may be a little bit of confusion here. I just want to make sure people realize as well that you don't have to have a cryptocurrency riding on the blockchain, right? So you can actually have transactions settled versus a synthetic token that is theoretically backed by US dollars, right? So you can completely avoid the usage of Bitcoin, of Ether, of anything else in the system, and basically create your own settlement modules. In fact, a lot of the actual private blockchains can reach out and actually access the Fed and be able to move US dollars as part of their settlement mechanism. So that's one of the benefits of this as well, too. And then when we think in our firm about the way that basically the chain structures will evolve, we don't really say that there's going to be, I think as we were just saying, one chain to rule them all. You'll actually have a chain that's very much specified towards asset classes, and then over time you're actually going to start to have standards develop. You may be familiar that R3 is very focused on creating standards. So once those standards are created, we'll start to have interoperability across the chains. Tokens will be able to hop across the chains, then we'll actually start to slowly have a graduation down to probably 3 or 4, at least in our opinion.
With apologies for being a Luddite, there are several acronyms that were thrown out. Can you just walk through those? I think there was KFC and BK Broiler, maybe some others. Thank you.
Well, KYC stands for Know Your Customer, and it's basically the financial institutions, when they sign up a customer, they have to know certain things about them just to make sure that they're not providing financial services to a terrorist or a criminal or some other undesirable element. So it's basically KYC, identifying the customer, it's got nothing to do with chicken. Sir.
S&P Global. Just a question which I think sort of continues this discussion. I'm a little bit confused. I sort of get the role of the miners and creating incentives to make the cryptocurrencies work, which, as I understand it, is basically creating this mechanism to incentivize people to verify the distributed ledger. But the whole discussion here is about, blockchain is all about a whole lot of other applications away from cryptocurrencies. So how in these other applications, use cases, as they're being called, is that problem of incentivizing somebody to actually verify what's on the distributed ledger, how does that get solved in these other use cases?
Leanne, since you're actually out there in the wild with this, we talk about how you do that.
Yeah, sure. So we use the token. It's a very bad word to use, but I'll use it for simplicity. I saw your face, Brian. I'm sorry to do that. It's blasphemy. We've used the token as a way to transfer the value and peg the item digitally to the transfer of that token. It's a vehicle, an electronic vehicle to exchange ownership or enable a part of, for example, if we had a number of banks involved in supply chain finance between 2 or 3 parties in the supply chain, it would be remiss of them to proliferate unethical trade. And so as a part of the transfer of funds, there must be accompanied with that transfer of funds a Kimberley certificate. And so as a part of that process at the moment, it's completely paper-laden, and neither parties are able to ensure that there has been a consensus around each of those validation points to be a part of that financial transaction. So we're using the token, again, I did the bad word, but I'm going to proliferate it, as a mechanism of being able to do that. We're not trading diamonds with Bitcoin or using cryptocurrency in that fashion, because our world in diamonds is still being used in a fiat currency sense, and there's still swift payment and transfers. But we're using the transfer of all of those fiat transactions and embedding that into an ethical source across its validation point. Does that kind of frame a part of where we're
I was just going to say, on a private blockchain, what you're really trying to do is you have lots of things happening around the chain, right? So you've got transactions, translations, if people are familiar with Swift messaging. And really what you're doing once the transaction processes through a consensus mechanism is that you want to be able to create an immutable record that basically is a proof of anything that's happened at a given point in time. Now, if you have a private blockchain where everyone has signed up to work together, they're actually incentivized to do that naturally, right? So you don't necessarily have to give a reward, because in our view, again, giving a reward on the Bitcoin blockchain is to be able to bring trust to a trustless environment. You need to pay somebody to be able to do all that work. In a private blockchain, everyone's there to be able to ensure that we have the best data possible, and as a result, you simply push the information to them and actually have them construct the block, which then hits the chain. So you don't have to pay mining fees in that situation.
Sir.
Yeah, Roger Cassabaum. I'm a teacher at Milton Community High School. And I was looking at, in terms of, okay, there's diamonds and there's money, but what about grading? Like if you, I think as a teacher, could give some student, one teacher in one school could get a C in chemistry and another could get an A, but the one who got the C might know more chemistry than A, than the other. So how could you maybe use blockchain to like validate what somebody knows and be able to trust that they know something?
Brian, go ahead.
Well, one thing that we're working on, another thing that people have suggested is, so I think what you're describing is not really a blockchain per se problem, but I do think that one thing that we experienced and one thing that we're working on are certificates for diplomas. So can you validate that person actually studied and graduated from that school? And then when you take that a layer down, can you authenticate what the grades or the transcript of that person, right? And we were talking to a school district who was quite interested in this because they get students who are coming in and out of their school district, and so they wanted an open, interoperable way to be able to transfer grades from different schools and different classes, which would have been really effective. But I know when I went to graduate school, they said you're accepted upon condition of receiving your notarized transcripts, right, from that school. And so UCLA sent my transcripts, right, and they put like a rubber stamp on the back of it, right, so that if you open it, you can see that it was torn. But what should happen is you just have a validated, kind of notarized in a way, transcript that is sent electronically, not through the mail. We are in the 21st century.
I'll just answer the diamond industry, of course. Certificates are used as a baseline for authentication and value. And what we saw in November last year was the HRD, which is in Antwerp, invoked a laser removal service, so they can literally remove the laser inscription from the girdle or the crown of the stone, which is great for us because we have the thumbprint, so it doesn't matter. But in our industry, what we find is we have resubmissions of grading of diamonds. So you'll have a diamond that will be submitted into a house in America, and if the value of that diamond is extracted, which mightn't be the value that the person wanted for insurance purposes or even for trade, they would retake that diamond and resubmit it to a completely different certification house, and then that might yield a different result. Now, given that we have the baseline with immutability around and identification around the object, we are able to detect those sorts of transactions or those sorts of misgrading atrocities. So potentially that could be something as well.
I think we have time for one more question. So,
Yeah.
We don't? Okay.
Just a question.
Okay. All right. Well, feel free to approach any of the panelists afterward. We could go on and on about this all day, but this is a great conversation. We're going to put a bookmark in the discussion right now, but thank you all for listening.